Since the early trade, oil prices have been trading upwards. The asset has already hit $80 per barrel, notching the biggest gain since the beginning of the year. Investors are hoping for a recovery in demand due to lifting of restrictions in China, as well as a possible slowdown in the pace of interest rate hikes by the Fed. Slow US wage growth and an unexpected contraction in the services sector have tempered market expectations of the Fed's further aggressive monetary policy. Furthermore, China, the world's biggest crude oil importer, has announced additional financial support measures for households and businesses aimed at beefing up efforts to rescue economic growth following months of rolling lockdowns. All this contributes to higher oil prices. Nevertheless, there are also factors putting pressure on quotes. For instance, OPEC crude oil output rose in December, led by a recovery in Nigerian supply from outages, despite an agreement by the alliance to cut production to support the market. Speaking of demand, winter in Europe is not yet as cold as it was predicted back in autumn. There is no risk of energy outages. This somewhat limits a bullish run in oil prices, so investors will have to wait for more significant news in order to change the situation. In the meantime, Brent crude oil futures slowed down the downtrend initiated last Thursday. Instead, the asset started to trade sideways within the range of 77.60 and 80.50, thus enabling buyers to take the lead. To gain strong upside momentum, the quote needs to consolidate above the 81 mark, otherwise range-bound trading may continue. Gold showed an impressive rally on Friday, reaching the level of $1,880. At the moment, the quote is trying to consolidate in this area. Moreover, the uptrend remains intact despite an overbought signal in the market. Thus, if the price stays firm above the $1,880 mark, it will most likely hit $4,900. Please bear in mind that traders will start looking in profits sooner or later, and which in turn may lead to a technical pullback down. A rise in gold prices can be attributed to statements by a number of Fed members who hinted at a possible slowdown in interest rate increases at the upcoming Federal Open Market Committee meeting. Investors inferred that the U.S. regulator could start cutting its benchmark interest rate by the end of 2023. That's what's driving the market right now, and thus gold has every chance of rising to $1,900 per ounce in the short term. As for the ruble, the Russian returned to work after a long winter holiday. The first full-fledged trading week was marked by a decline in the dollar below 70 rubles. In that case, the ruble simply followed other currencies that had managed to post strong gains on Friday. Investors are just starting to enter the market, with the ruble largely copying the dynamic of major currencies. After a while, the Russian currency will return to the levels seen throughout the past year, when it moved by its own rules, focusing solely on political factors. At the moment, there are no signs of a trend change. Most likely, the quote will remain range-bound between the levels of 68 and 73 rubles per dollar. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.